REITs. REITs just basically stand for Real Estate Investment Trust. Interest rate have adjusted down last month itself, and part of the community were very excited because REITs would be the group of investment vehicle that will get benefited. Why? In a broad stroke, REITs depends on debt. Real estate investment trust depends on borrowing. And when they borrow money, their interest rate, if it's too high, it will eat up into their costs. So it's always good that the debt can be very low. Then with the profit that they make, right, can pass to investor as dividend. So for those who are new to REITs, you can see it as a collective investment scheme. And with this collective investment scheme, right, the group of investor, which is known as unit holder, they will provide funds to this vehicle called REITs. And then within this REITs, you can hire this manager. So this manager would decide what to invest, what to divest. And when they manage this portfolio, this investment, if in a way the revenue after cost can give you some profit, this profit will pass back to our unit holder as dividend. And a lot of time, these REITs are focusing on real estate. So for individual investor like us, we can either choose to invest in properties, which is real estate, or choose to invest in real estate investment trust. So why the difference? So what is the benefit of investing into REITs compared to single unit or properties? If you invest in a good investment REITs and stuff, right, it will provide you diversification in terms of like numbers of building. So for example, if you're an individual investor, the same amount of money, for example, like 20,000, 30,000, you can only invest in single property. So your risk is very concentrated. Compared to 20,000, you invest in the REITs. This REITs itself have a few buildings and you have spread out your risk. All right. So diversified is first thing. Second is affordable. Affordable in the sense that for properties, your so-called deposits or your first initial investments might be 5, 6 digits or even 7 digits. But for REITs itself, it depends on the units you bought. So for example, you buy like Fraser Center Point. Right now it's like 220, 230. You need to buy like hundreds multiple. So it's like $200, $300 you can buy a units of REITs. And of course, it's more liquid. Liquid in the sense that exchange to the market, but you can buy and sell easily. For single property, you cannot sell away maybe your washroom, your living room. But your real estate investment trust, you can. So that's why the liquidity come in. And of course, less hassle. Diversified, affordable, is liquid and less hassle. But of course, if you invest directly into property investor, most of the time you have leverage. Means you borrow to buy. For example, this property price at 1 million, you put deposits or put your initial investment of 20%. The remaining 80%, you can go to the bank and ask for a loan. But it's leverage. If you got hit, have some cascading effect, for example, forced liquidation. Actually, it's not all bad. The good thing is, first, you have control of the property, of course. And then the second thing is, your property price will not be as volatile as a REIT investment. So REITs, every day you have stock market, right? The price go up and go down. So the volatility is somewhat more stable compared to REITs. And then if you invest in REITs, you need to analyze every single REITs. So is there another vehicle whereby, let's say, I would like to reduce this single REITs volatility? Can I invest in a group or a pool of REITs? Yes, you can. So there's REITs ETF. But if it's REITs ETF, it's more diversified. So let's say this REITs got 100 building. You got 4, 5, or even 30 REITs. Every REITs have 30 to 50 building. So you can spread your REITs across the thousands of units of properties. Of course, less hassle, you don't need to analyze every single REIT. So REITs ETF have the advantage. Right? So what are the Singapore REITs ETF you can find? If you know Kevin Investing, so one of the friends that I met, and also we have runs events, and then I also invited him to share in our community. So he's a very generous person. We can go to the YouTube channel. So there's like 5 that I gather right here. So there's a few things you need to take note. First is AUM, which is size. So for ETF, broad stroke, the bigger the ETF, the lower the expense ratio is. Means, let's say it's like compared to a person's that manage 1 million, you need to pay the same management fee compared to a person's that manage like 100 or even 1 billion. The bigger the size, the management fee in terms of like percentage will get lower. This explain in expense ratio. So the bigger the AUM, hopefully it translates in a lower expense ratio. So you can see the expense ratio from 0.6, 0.55, 0.5, 0.4. So the bigger AUM, the better it is. Next thing, dividend yield. So the dividend yield must make sense. And then please don't be confused by the distribution. For example, we rely on regular cash flow. Yeah, maybe quarterly or semi-annual makes a big difference. But for me, I just thought that actually the frequency doesn't make big difference per se lah. So more of it like what's your strategy, what's your required dividend yield, and also AUM must be big enough to provide liquidity so that you are not hurt by the price gap. How do I analyze REITs? Very simple. First, you can go to SGX screener. So of course, SGX only show Singapore listed REITs, and then the screener system is quite limited in that sense. It's SGX listed. The most accurate data is from there. Next is also another friend of mine. So this is Victor. Initially, when I learned about investing, right, I learned from them one. Victor is one of my 老师, one of my teacher. Rusmin as well. So both of them, they run the fifth person. So you can go to the fifth person, look at their data itself. Or this retirement site. So retirement site, if you go to the page, right, you can select the so-called REITs and compare site to site. Perplexity. So the downside is they only have US data. So if you like to invest to get dividend, you can invest in US stock, yes, but just to be mindful, US stock, there's a dividend tax rate of 30%. So for me, I use physical.ai screener, and the criteria that I look at is these 4 different items. First, asset size. Second, NAV. Do their NAV per share, which is the asset size, grow? Distributions. I would like my dividends to grow as well, not just your property, my rental also grow. And of course, in the end of the day, does the yield make sense? For me, I only look at Singapore REITs because local REITs, I can easily access the information. Of course, if you like to look at Malaysia REITs, you can just open up Malaysia region. Or if you like to look at Hong Kong REITs, you can just open up Hong Kong region. They have the best so-called best data source that I find out there, and there's also the best tool, best interface in terms of like so-called individual investor. So they have this physical.ai, you can just go to screener function. If you look at REITs, right, you just need to, in terms of industry, right, just scope it down to pure REITs investment. So there's diversified REITs, mortgage REITs, healthcare, hotel, retail, residential, office, industrial. So all of these are REITs. All have different characteristics. So in terms of countries, I just select Singapore. You can type in Malaysia or even Hong Kong. Why all these countries at the current moment? Because the dividend don't need to pay tax. So remember the 4 items, the total assets, the NAV per share growth. Here I just put tangible book value. Next thing is the dividend per share growth. So in REITs, right, the term should use distribution. Distribution in the sense that because it's unit, they call it distribution per unit. But for physical.ai, right, I think when they allocate their data, right, they put under dividend. So just put dividend per share or dividend yield. And then one more thing. Oh, I didn't put this debt ratio. So there's a requirement for all the REITs, especially in Singapore. The maximum that you can go to is 50%. First thing, I would like the asset size, right, to grow. And what I can screen right here is at least 0% means even if you're not grow, your tangible book value, which is your assets per share, right, won't shrink. So I set 0% right here. And I want my dividend yield to be at least 3%. So to be fair, I should go for at least 4, 5, or 6%. 3% cannot be inflation, but here is just the sake of screen out some of the good dividend. Maybe at this point of time, the dividend yield is low, but when there's price movement, right, maybe your dividend yield will change higher. So I just the sake of screen out the company first. And of course, in the end of the day, I want a debt ratio to be lower than 0.5 or even to be lower, 0.4. You can do that as well. And tonight, I'm using physical.ai. If you haven't used before, these 14-day trials, or if you want to pay, is $39 per month. For me, very straightforward. I just have a peace of mind. I invested my CPF money into this REIT called Fraser Centrepoint Trust. This is not a recommendation, just to share. Because for me, if I like to go to some space in the weekend or even like weekday to enjoy aircon, food, gathering with friends, Fraser Centrepoint is the place that I go. North Point, Causeway Point. They are the 2 biggest ones. But of course, 2027 is coming. The RTS in place, will it affect Causeway Point? I think even without RTS, I already feel this. But of course, with RTS, the heat will be stronger. So I would say, I'm still in observing the status right here. How Fraser Centrepoint will address their tenant mix.
Like what you are seeing so far, give the gentle tap on the like button. It's free. And don't forget to subscribe for more investing story.